Assalamualaikum. Welcome to lecture 3 of financial reporting. This lecture is the revision of IAS 1. So your IAS 1 before, which we use for the presentation of financial statement, has been replaced by IFRS 18. So the changes are not so major, but some areas had been majorly changed and some areas there are some minor changes, maybe changing in wordings and things like that. Okay, so in this lecture we are going to go through the financial statements, IFRS 18, then the general requirement for the financial statement under IFRS 18. First, we are going to go through the objectives of financial statement, complete set of financial statement, role of the primary financial statement, frequency of reporting, consistency of presentation, disclosure and classification, comparative information, aggregation and disaggregation, principles of aggregation and offsetting. When can you offset? Then statement of financial position. See, basically this standard IFRS 18 is used. It will help you how to prepare your financial statements. How do you classify? Then how do you present? How should you disclose? Okay. Now, under statement of financial position, first distinction, current and non-current. How do you distinct your current assets and liabilities versus non-current assets and liabilities in your statement of financial position? First classification distinction is the next. Structure, how should be your statement of financial position look like? That we'll see in this lecture. Then minimum disclosure for financial position. Next, we are going to go through statement of performance, also known as statement of profit and loss and other comprehensive income. Before, under IS 1, it was known like that. Now the name has changed to statement of performance, but it's the same only. Statement of profit or loss or statement of performance, because your profit and loss measures what? Performance only. So how this is presented, then what are the categories in the statement of profit and loss? See, these categories in the statement of profit or loss, major change took place in this category. Earlier this was not there under IS 1. Now, totals and subtotals in your statement of profit and loss. Minimum disclosure in the statement of profit and loss. Then operating expenses. Format of the statement of profit and loss. Statement of profit and loss and other comprehensive income. Then allocation of profit and total comprehensive income. Then we are going to go through statement of changes in equity. What information should be presented here? What should be the structure? Transfers within equity. Then notes to the financial statements. Remember, IFRS 18 not only looks at your financial statement but also the notes to it. So what does IFRS 18 has to say about this? The structure of your notes and capital and other disclosures. And finally, we are going to conclude with the syllabus, the summary, and whether there are any technical articles on IFRS 18 that you have to read on your ACCA website. So this was the presentation. Okay, we started with IFRS 18, then we see when we can aggregate and when we should not aggregate, and offsetting. Then we went through the 4 financial statements, that is statement of financial position, statement of performance, statement of changes in equity, and notes. Okay, now IFRS 18. What is the objective of IFRS 18? This is a new standard that has come. So IFRS 18 has a higher chance of appearing in your exam, both for SBR and financial reporting. Since this is new, they have more things to test on this area. So objective is that it sets out the requirements for your presentation and your disclosure of information in a general purpose financial statement. So that when you are providing information, you are giving relevant information that faithfully represents entities' assets, liability, equity, income, expense. In my previous lecture, lecture number 2, under conceptual framework, I have already defined what is the meaning of assets, liability, equity, income, expenses. These are the elements of the financial statements. And the 2 qualitative characteristics, fundamental characteristics, are faithful representation and relevance. So IFRS 18 helps to achieve that objective. Faithfully represent the elements of the financial statement, the 5 elements. Now the scope up under IFRS 18. Entity who prepares financial statements in accordance with the IFRS standard, they should apply IFRS 18 and they should present and disclose financial information according to IFRS 18. Now, general purpose financial statement. General purpose financial statements They are general purpose financial reports that provide information on entities on the elements of the financial statement. They are your assets, liability, equity, income, expense. This we all know. General purpose financial reports are reports that gives financial information to the users to make important decisions. For example, they want to make decisions whether they have to buy, sell, or a whole equity or debt instruments, and whether in providing or selling loans and other forms of credit. So in order to make these decisions, they need information. They need financial information about the entity. And how do they get this information? Through general purpose financial report. So that's why when you're under general purpose, remember, the general purpose reports includes two things. General purpose financial statement number one. Number two, sustainability related financial disclosures also. Okay. Next, objective. Okay. So objectives of financial statements. Again, same. To give information about assets, liability, equity, income, expense. That will be helpful to the users of the financial statements in making decisions about the entity. Now, these are the complete set of your financial statements. It includes statement of financial position, statement of performance. Remember, your statement of performance can be divided into two separate statements or one single statement that has both profit and loss and other comprehensive income, or profit and loss in a separate statement and other comprehensive income in a separate statement. Next, statement of changes in equity, statement of cash flow, notes. So in this lecture, we are going to go through 4: financial position, financial performance, changes in equity, and notes. We are not going to attach cash flow. And then, not only that, in order to compare, you need comparative information that is relating to the preceding period, the year before you have prepared your financial statements. For example, you are preparing financial statements for 2024, 31st year end 31st December 2024. You need for 31st December 2003 also, 2023 to compare. Next, statement of financial position at the beginning of the preceding period if there is a change in accounting policy or there was an error that is corrected. That time you need from the before, you have to take the beginning period of the year before that. Then, so they are referred to as primary financial statements. Okay. IFRS 18 does not mandate the use of specific names for individual financial statements. For example, statement of financial position can be referred to as balance sheet. It is not, IFRS 18 is not saying that these names are fixed. You can also call financial position in the name of balance sheet, they are same. Okay. Now, what is the role of the financial statements? First is users need. Okay. So when you are giving information to the user, you have to give a good summary of company's assets, liability, equity, income, expense, and also cash flow, so that users can understand, they can get an overview of this element, and they can make comparisons between the entities and also between the reporting periods for the same entity, and they can identify areas about which they wish to seek additional information in the notes to the financial statements. Next, format. So the primary financial statements are useful. Okay, if they have to be useful, they should comply with the specific requirements of IFRS 18 that are described in this lecture. So in respect of the presentation and disclosure requirements of other IFRS accounting standards, IFRS 18 states the following. Remember, this presentation and disclosure requirements you have under other standards also. For example, if you go through IS 16 or IS 38, intangible assets or property, plant and equipment, even they have a rule how your assets has to be presented, how it has to be disclosed. But what IFRS 18 has to say, let's see that. Where other IFRS standards provide presentation and disclosure guidance, including minimum requirement, this need not be applied if it does not result in material information. Remember, for example, let's say your IS 16 says you need to disclose certain information about asset, but if they are not material information, then even if IS 16 says so, you don't have to disclose the information. That's what IFRS 18 is telling you. Okay, so you need not apply it. Next, if your other IFRS accounting standards require a separate presentation of specific line items in your primary financial statement, then this requirements need not be applied if doing so is not necessary for the statement to provide a useful structured summary. So if you are thinking that if you provide that information and it is not giving a useful summary, then you should not go ahead with the standards rules. Okay, that's what IFRS 18 is saying. One, if it's not material, do not disclose it, even if another standard is saying so. Next, do not separately present an information about a specific line item if doing so is not giving you a useful summary. Okay. Now, frequency of your reporting. A complete set of financial statements, whether it is cash flow, statement of profit and loss, balance sheet, they have to be provided at least annually. Okay. So normally we prepare consistently to a specific date every year. So IFRS 18 also permit entities to prepare their financial statements for a 52-week period. That means every year you are going to have a different reporting date. Okay. Next, an entity can change their reporting date also. If this is the case, then they will prepare their financial statements for a period that is longer or shorter than a year. So in this case, you have to disclose this fact and you have to state the amount in your financial statements that are not comparable. Because of course, if you one year you are preparing for a short year, the other one you are preparing for 52-week period, you can't compare. They are not like with like. Both has to be prepared for a 52 weeks period, then only you can compare. That's why you have to make it a note. Next, role. Presentation and classification of items in the financial statements have to be retained from one period to the next. That means suppose in this year I'm presenting an item in this manner. Next year also I have to make sure that I'm presenting it in the same manner. I can't change. Otherwise comparability becomes very difficult. Okay. But you can change if an IFRS accounting standard says you to change the presentation. For example, this year it's non-current, but IFRS accounting says that now you have to change from non-current to current. Reason could be anything. Then you have to change. Or another presentation or classification is more appropriate. Okay. This is, we are considering it under IS 8. IS 8 means we look at the selection and the application of accounting policies. We are feeling that if you apply the accounting policies in this manner now, it's more better, more suitable. So in this two situation, you can change. Otherwise, normally, the change does not happen very frequently for all the items. Okay, it's maybe one or two items. Next, comparative information. So for comparison purpose, at least the preceding period's result may be included in your current period financial statements. So if it's a numerical information, then you have to disclose unless an IFRS accounting standard permits or requires otherwise. If it's a narrative and descriptive information, you have to include. See the difference. If it's numerical of the previous year, disclose only. If it's narrative, you have to include. When it is relevant to understanding the current period's financial statements, for example, regarding legal cases. Legal cases are pending for many years. You need to include them in your current financial period, even if it's narrative. Okay. Next. So when the presentation or classification of items in the financial statements is amended, it's changed, then if practicable, okay, reclassify comparatives and disclose the nature, amount, reason for reclassification. You have to reclassify the comparatives also. In the current financial statements, if you are changing the presentation or classification, go back and reclassify the comparatives also. Then only you can compare. And when you are doing so, not only reclassify, disclose it also. You have to disclose the nature of it, the amount of it, and reason for reclassification. If it's not practicable, disclose the reason why you're for not reclassifying and the nature of changes which would otherwise have been made if you would have reclassified. Okay. If an accounting policy is changed or a prior period error is corrected, you need a third statement of financial position. It's required to be presented as at the beginning of the prior financial year. Now we are moving on to the aggregation and disaggregation. What are the principles? IFRS 18 says for companies to either aggregate or disaggregate information that are presented in the financial statements and disclosed in the notes, they are based on certain principles. First, items. Items, whether it is asset, whether it is liability, equity, income, expense, or cash flow, you can only aggregate if they are sharing the similar characteristics. And if they're not sharing characteristics, you have to disaggregate. You can't aggregate. Aggregate means you can't add them together. Information again should be aggregated or disaggregated based on the primary financial statements and the notes fulfill the roles described in section 2.3. Aggregation and disaggregation should not hide, okay, they should not hide your material information. If by aggregating it is hiding material information, then you should not aggregate, you should separately disclose. Okay, and if disaggregation is making what do we say, you're not able to figure out what is important, what is not so important, so much information to read, you're not able to get a bigger picture, then disaggregation should be avoided. Now, material information. What is the meaning of material information? Let us understand. Any information, if you omit or mislead, can reasonably be expected to influence the decision of the user based on that decision, based on that information. That means it can change the decision. If that information would have been there, your decision would have been different. But now that information is not there, your information is different. That is the meaning of omitting. When you omit an information, that it can influence. Same for misstating also. So that is material. See, if it is not material, whether you omit or not, the decision of the users won't change. It will not impact it so much, right? So that's the immaterial. Okay. IFRS 18 suggests that the following items you have to disaggregate. Either they have dissimilar characteristics, that's why, or because the resulting information is material. If the resulting information is material, you can't aggregate. You have to show separately the material information, whether in the primary financial statements or in the notes. Okay. So these are this information that needs disaggregation. This table will help you. Items in the statement of profit and loss and item in the statement of financial position. So in the profit and loss, if it's inventory, write down of inventory, you can't aggregate. You have to disaggregate and show. And also any reversal of write downs. Next, impairment losses. So impairment, if there is any reversal of property, plant and equipment impairment, you have to disaggregate, show separately. Income or expenses relating to restructuring. Again, you can't show them under your trading income. You can aggregate. You have to show it separately. They are material information. Because restructuring does not happen very frequently. It's a non-recurring event. Next, income or expenses relating to disposal of property, plant and equipment. Again, you have to show separately. Income, expenses from litigation settlement and non-recurring income and expenses. Income and expenses that happens once. That is the meaning of non-recurring. It does not recur. This you have to show separately. Next, in the side of the financial position, your property, plant and equipment, that is your non-current asset, you have to disaggregate into IS 16 classes. Next, receivable. Receivable also comes in the statement of financial position under current assets. So you have to disaggregate your trade receivable, prepayment and other amounts. For inventory, you have to disaggregate into finished goods, work in progress, raw material. Provision, disaggregate according to nature. Equity, capital, reserves, disaggregate into various classes. Because you see, equity, we have premium, we have preference shares, we have equity shares, share premium, general reserve, revaluation reserve. Okay. Now, so line items, totals, subtotals in the primary financial statements, they should be labeled in a way that faithfully represents the characteristics of the item. So to achieve this, description and explanations may be required, including how items have been aggregated or disaggregated. Now, offsetting. Assets and liabilities and income and expenses, you can't offset. Okay, they should not be offset unless another IFRS accounting standard is requiring or allowing you to offset. For example, IS 12 says, okay, under IS 12 income tax says, a tax liability you can offset against a tax asset under certain conditions. Of course, when I go to IS 12, you can know what are those conditions under which you can offset tax asset with tax liability. But offsetting, except when they offset faithfully replace the substance of a transaction, reduces the ability of the user to understand the transaction and events which have occurred and inhibits the access to ability to assess future cash flows. This means, other than if it faithfully reflects the substance, other than that, if you offsetting is not taken in a positive way. Why? Because if you offset, for example, you show your net asset, you deduct your liabilities from assets, you don't know what are your obligations at the end, because you are standing with higher assets than liabilities. You are having a net asset, but you don't know what are your liabilities. Same with income and expenses. If you show net amount, you deduct expense from income and show the amount, you don't know how much your expenses. If you don't know how much is your expenses, you can't have a control over your expenses. But by showing income and expenses separately, you now know which side you have to control, where your expenses are going, okay, what are uncontrollable expenses, things like that. So offsetting is not, it reduces the ability of the user to understand the full picture. You can analyze the company properly by offsetting. Offsetting is not taken in a good way. But if offsetting faithfully reflects the substance of a transaction, then offsetting is good. But normally, offsetting is not allowed. And very rarely you will see a standard allows offsetting. Okay. So if you present your assets net after an allowance, remember that is not same as offsetting. That is not offsetting. Of course, you can show your assets net after an allowance. If you have an allowance, you deduct from the asset and show. For example, receivable. For receivable, from trade receivable, we deduct the allowance for credit losses and we show trade receivable as net. This is not offsetting. Okay. Now, statement of financial position, current, non-current distinction. So your assets and liabilities are divided into current, non-current. Okay. This is the classification that we have been going through years and years, unless a presentation is based on liquidity order that provides more useful information. For example, a financial institution, they might want to present not based on current, non-current, maybe based on liquidity. But normally it's non-current, current only. So whichever method you adopt, whether based on liquidity or current, non-current, okay. If a classification includes amounts which will be settled or recovered in less than 12 months and more than 12 months, amounts that are more than 12 months you have to disclose. Of course, amounts that are less than 12 months you will write in the current financial statements. But if it's more than 12 months, you will disclose it. Okay. So deferred tax asset or liabilities should not be presented as current. Deferred tax asset and liabilities will do under IAS 12, okay, which I'm going to cover in my lecture 17. Now, an asset or a liability is classified as current if it satisfies at least one of the following criteria. For asset, you are expecting to realize, sell or consume in the normal operating cycle. Usually it is 12 months. For liability is the same. You expect to settle your liability in the normal operating cycle, normally 12 months. For asset, entity holds it primarily for the purpose of trading. You're holding that asset for the purpose of trading. And for liability, you're holding it for the purpose of trading. Same reason. You are expecting to realize your asset within 12 months. And you are expecting to settle your liability within 12 months. And asset is cash or cash equivalent unless you cannot exchange or use to settle a liability for at least 12 months after the reporting period. Same. Entity does not have the right at the end of the reporting period to defer their settlement for at least 12 months after the reporting period. That means you have an obligation which you can't deny, you can't avoid. Okay. You can't defer also. You can't defer. You have to pay, means within 12 months you have to pay. You can't defer that payment after 12 months. So this condition is current. Same for assets also. Now the structure. So IFRS 18 does not prescribe the overall structure of financial statements. In practice, there are two main types of format which are there. Basically, they are expansions of two different expressions of your accounting equation. Remember your accounting equation, your basic accounting. When you first started your accounting classes, you must have been introduced with your accounting equation that your asset minus liability, also known as net asset, is equal to equity. This is one expression. And this is one way financial statements could be drawn. Next way, which is very popular and even which in ACCA financial reporting and SBR we also follow, is the second method. Your asset is equals to equity plus liabilities. In that liability, we have both current, non-current. Okay. Same meaning expression, but the way it is shown is in two different expressions, but it's same only. Both methods are consistent with your IFRS accounting standards, but the guidance on implementing IFRS 18 illustrates only the second format. If you see all your example, it is on the second format. Asset is equals to equity plus liability. So remember this throughout your FR and also take it to your SBR also. Now let us see. This is the format I've been talking about. So you have been given two separate years. You will always see like this, showing two separate years. Why? Because you need one for comparative. This 2001 is for comparative. This 2002 is current year. Always there will be two like this. So this will be the label such statement of financial position as at a particular date. Okay. Then this is how you start. Assets common. Then you start with non-current assets. We always start with non-current assets first and then current. So under non-current assets, we have property, goodwill, intangible, investment in associates and joint ventures. And we add together and we get this as total non-current assets. So for each of them, we have separate standard. For example, property, plant and equipment, we have IS 16. Goodwill, intangible, we have IS 38. Investment in associates, joint venture, we have IS 28, which we are going to study later on in my later lectures. Okay, then moving on to current assets. We start with inventory because inventory is the least liquid, okay, and we move towards more liquid. That is the order. Then trade receivable, cash and cash equivalent, and other current assets. So for inventory we have IS2, and for trade receivable is a financial asset. We have IFRS 9, and cash and cash equivalent will do in IS7. Okay. Then we get total current assets. And finally, total non-current assets will add with total current assets and get our total assets here. Then assets from here to here is asset part is over. Now we are moving to equity and liability. Remember that formula, that equation, asset is equals to equity plus liability, it's same. So first we'll finish the equity part. Equity to the owner of the parent. We start with share capital, then we have retained earnings, and we have other components of equity. And then we get our total equity. And after we get total equity to parents, there is one section known as NCI, non-controlling interest, also will put. And then total equity. So since the pro forma, the statement of financial position is very lengthy, it's not able for me to put it in one slide. That's why I had to put it in the next slide. The other half of this, that's after total equity, continuation of it is in the next slide. I'm not able to put everything in one slide because then it's very big, and also the font becomes very small and it will be difficult for the reader to actually see it. So after total equity is your, this is the continuation only, it's the same thing. From total equity downwards you will write non-current liability. After non-current only you will write current liability, same like assets, first non-current then current. So non-current liability, we have borrowings, we have lease liability, we have provision. Lease liability we are going to do it under IFRS 16, leases, then provision IS 37, deferred tax liability IS 12, and remember deferred tax is always non-current, okay, and provision also, and lease also. Then we write total non-current. Then under current again we have borrowings. See, borrowings differ, okay, borrowings could be current or non-current. If it's more than 12 months, non-current, less than 12 months, current. Lease also could be current if it's less than 12 months. Payable usually is current, payable for goods or services, and provision could be current if it's less than 12 months, and income tax payable. Deferred tax is non-current, but income tax payable, the current tax is current liability, and then you add them together here, get the total current liability. So total non-current plus total current is your total liability. These are in bold, and you get total equity and liability. You will add here your equity and liability, and this is the place you have to see whether it is balancing or not. Your total equity and liability has to match with your total assets. I'll go back to the previous slide. So total equity and liability has to match with this figure, total assets. Then you know your balance sheet is balancing and you have put everything correctly. Now, there is a asterisk mark here. As you can see here, we'll see why. That is a note on terminology that is used, okay? So now, the illustrative statement of financial position above is taken from the IFRS 18 illustrative examples. This format will be used in your questions, in your financial accounting, as well as your financial reporting. The terminology that is used is not mandatory, and you should be aware of the following. Number one, payable for goods and services. This is commonly referred to as trade and other payables. Okay, remember shorter term is used in your study hub. Next, income tax payable can be referred to as current taxes payable also. That's the same. Okay. Now, minimum disclosure under financial position. These items you they must be shown in your statement of financial position if they are material. So the minimum requirements for this line items, okay, line items, they can be in any order because the order is not prescribed, okay. They are this: property, plant and equipment. You have to make a note for this, okay. They are line items: investment property, intangible assets, goodwill, financial assets, okay. But financial assets other than equity accounted investments, because they'll be shown under equity, and if it's trade receivable, it will be shown under current assets, and cash under current assets. So other than that, financial assets. Then investments under equity method. Biological assets, inventories. Biological assets, by the way, we have IS 41 for that, agriculture. Then inventories. And investment property, we are going to deal under IS 40. Okay. Next, trade and other receivable. Cash and cash equivalent. Assets classified as held for sale. IFRS 5 is going to deal with that. So these items should be shown in your statement of financial position because mostly they are material. Okay. Every statement of financial position will have this figure. These are the minimum requirements. Next, trade and other payables. Provision, financial liability. Liabilities and assets for current tax, deferred tax. Liabilities in disposal group classified as held for sale. Non-controlling interest, issued share capital. Reserves, and the aggregation and the disaggregation principles have to be applied to all these line items. That gives a useful summary of your entity's assets, liability, and equity. Wherever you can offset, wherever you can aggregate them, you can. But wherever you can't, then you should not. Now, from financial position, we are moving on to statement of performance. All items of income and expense recognized in the period must be presented either in a single statement of profit and loss and OCI, that is other comprehensive income, or two statements. A statement of line items of profit and loss, and a second statement which begins with your profit and loss and displaying items of OCI. Now, IFRS 18 categories under profit and loss. So IFRS 18 requires all your income and expenses to be classified into these 5 categories. This is completely new, not there in under IS 1. First, under operating category, investing category, financing category. Before disclosing the other two, can you recall something by this 3 category? It reminds me of statement of cash flow. Even under cash flow, the cash flow, we divide this into 3 categories. See how they are bringing the reason of the changes in a standard is to bring this in align with the other statements. Earlier it was not like this. Now this is similar to your statement of cash flow, so it's easier to compare also your profit and loss with your cash flow, because under cash flow also we used to divide into 3 categories: operating cash flow, investing, and financing. Same they are doing for income and expense also. And after that, income tax category and discontinued operation category. So we'll see. So the general classification, these are the general classification requirements. They will be described below. We'll go into 5 of them in more detail now. But remember, if your main business activity is different, their classification changes. For example, if your main business activity is investing or giving finance to customer, then giving loan comes under your operating. Giving loan, the expense and the income relating to loan will become your operating activity, operating category. Then it will not be, normally for us it's our financing activity or investing financing activity, but for you it will become your operating activity because that's your main business activity. This is usually for banks. And if you are in an investment company, your main trading is investment, then your investment activity, for example, investing in buildings is your operating activity. They're not investing. But normally, for your financial reporting exam, we don't go by those exceptions. We go assume that we are not in the bank, or we are not in the investing, we are not in the active business activity of investing. So we go by the general classification requirement. That is for us. If we go by for any investing, it comes under investing, and if we go for financing, it will go under financing category. Okay. First, operating category. All income expenses that are not categorized in one of the other four are in the operating. Very simple. So all your revenue expenses that are associated with your normal trading activities, such as cost of goods sold, salary, general, admin, selling expenses, amounts that are relating to plant and equipment, for example, your depreciation, impairment loss, profit and loss on disposal, all comes under operating category. Now the second, investing category. So under investing category, certain items of income and expenses are associated with investments that are held by an entity. This table will give you a summary that you are likely to see in your financial reporting exam. So, the type of investment and the income and expenses in investing category. So, the first investment, associates. Associates we are going to cover in lecture 25 in detail. So, the profit, the income relating to associate, that is the share of profit of associate. So, this will be going under your investing category. Next, cash and cash equivalent. The interest income is the income from this investment. Next is financial assets. Financial assets we are going to cover in detail in lecture 18. That is under IFRS 9. So here, if your financial asset is an investment in debt, for example, you are giving loan to someone. So in exchange of that loan that you are giving, you are going to receive an income. So that is an income for you, interest income, but it's under investing category. Next, if the investment, the financial asset that you are having is the shares in a company, then you are going to receive dividend. So that dividend income is also an income from the financial asset, but it is under investing category. Then any gain or loss on remeasurement of your financial assets to fair value, again under investment category. And transaction cost associated with the purchase of your financial asset, again that expense is under investing category. And finally, any gain or losses on the disposal of financial asset are under your investment category. The next investment property, which we are going to cover under lecture 10. It's in your IS 40. So from investment we have rent, that is a rental income, and any gain or loss on remeasurement of your investment property using fair value, and gain and loss on the disposal of investment property. So other expenses that are associated with the assets listed above, for example, repairs and maintenance associated with investment property will fall under operating category, not investing category. Please understand. For repairs and maintenance, I'm talking about repairs and maintenance expenses relating to any of this investment property. The four investment property that we have just went through, financial asset, investment property, cash and cash equivalent, and associate, falls under operating category. That's why I've highlighted it in bold, operating category. Next category, financing. Financing category includes all income and expense relating to recognized liabilities. So in order to determine exactly what item of income and expenses are included in your financing category, IFRS 18 requires that the liabilities are classified as those that arise from raising of finance only, and those that do not only arise from raising of finance. There are two types of transactions. Only the raising of finance. The other transactions is not only raising of finance. So a transaction that involves only the raising of finance is one in which an entity receives finance, that is usually in a form of cash, at a later date, and then they repay this amount. Income and expenses that are not classified in finance are classified in operating. Now we have to go through this table to understand transaction that involves only raising of finance, transaction that do not involve only raising of finance. versus types of liability and income and expenses in the financing category. So first liability is your debt. Debt we usually take to raise finance. For example, loan notes that you will repay in cash. Okay. Again, we'll cover this in lecture 18. Debt that are repaid, that will be repaid in entity's own shares, not by cash, but repaid in entity's own share. Again, we'll cover in lecture 18. So these are the two types of liabilities that occur only when you want to raise finance. Okay. Those items, liabilities, which do not occur only for raising of finance. They could be any other purpose. One, your trade paper, not only for raising finance. Next, contract liabilities, which we are going to cover in lecture 5 under your IFRS 15. Lease liability, we are going to cover in lecture 14 under your IFRS 16. Then decommissioning provision under lecture 15, IS 37. A litigation provision, again lecture 15. And government grant, lecture 9 under IS 20. So this type of liabilities are not only for raising finance. So any income and expense that relates to those liability for which we are only raising finance, then the gain or loss, whether from initial or subsequent measurement, gain or loss, so they will be under financing category. Okay, the liability. Now income and expenses, income, gain or loss, then gain or loss on derecognition, transaction cost relating to the acquisition or disposal if recognized in profit and loss. Now for income and expense in the financing category, for those liability transactions that are not raised only for financing, that is interest, income or expense, if this amount arises as a result of applying the relevant IFRS accounting standard. Okay. Now, to understand this better, let us go through the 6 transactions. This is activity 1, financing category. So for each of the following items of income or expense, you have to explain whether they will be presented in the finance category or not. First one, liability, interest on a lease liability. Second, year-end gain on a remeasuring corporate bonds issued by an entity in accordance with IFRS 9. C. Dividends paid on a redeemable preference share. D. Expense relating to the recognition of a provision for litigation. E. Recognition of a deferred government grant as income. F. Increase in a decommissioning provision arising from the passage of time. Now let us go to the solution of this. First, interest on a lease. So on the left hand side we are given the transaction, and on the right hand side the answer is given, the right column. First, interest on lease liability. Okay, this one. So lease liability, tell me, a lease liability, whether it arises, if you can remember that table that we have just gone through, tell me whether it is only arising for finance or not. No, a lease liability does not arise from a transaction that involves only the raising of finance. Correct. So the interest calculated as required by the relevant IFRS, that is IFRS 16, will be classified in the financing category. We told, right? So the interest on the lease liability will be included in the financing category. Done. Next one. Regarding year-end remeasuring of corporate bond in accordance with IFRS 9. So this one arises from the transaction only raising of finance. So therefore, the income and expense also, and the measurement and the derecognition of the liability as well as the transaction are classified in the financing category. So the remeasurement will go in the financing category. See, if you raise anything for finance, then the income of it, the expense of it, the measurement, derecognition, transaction cost, everything will go in the financing category. That's why remeasurement will go in the financing category. Understood? Now, part C. C is about dividends on a redeemable preference share. So if you see this is also only raising of finance, the redeemable preference share liability. So expense and income will go in the financing category. Okay. So the dividends are included in the financing category because they refer to the remeasurement of shares. Next, D. expense relating to the recognition of the provision for a litigation. You have recognized an expense has been arisen. Why? Because you have recognized a provision for litigation. This does not arise for raising of finance. So therefore, only the interest that is calculated as required by the relevant IFRS, that is IS 37, will be classified as financing category. Only the interest element. But in this case, that is an expense. Expense will not come in the financing category. If it was interest, yes. So expense that is associated with the recognition of a provision will not be included in the financing category. I hope this makes your doubt very clear now. Okay. E, recognition of a deferred government grant as an income. So this also does not arise only for raising of finance. First understand that. Therefore, only the interest will be taken as finance. But this is not interest. So that's why the grant to income is not included in the financing category. And F, increase in decommissioning provision due to passage of time. So a provision will not arise only for raising of finance. Only the interest element will be taken in the financing. So therefore, the increase that arises from the passage of time represents interest. So this will be included in the financing category. So in short, if I have to give you a summary after all the 6 items, if anything is only arising due to finance, only as a raise of finance, that means any transaction taking place only to raise finance, okay, then what happens? Then all of its element will be in the financing category. Okay, as simple as that. Anything to do with finance, only finance, it's income, it's expense, it's interest, it's remeasurement, it's a transaction cost, everything will be taken in the financing. But those items which those transaction which involves not only raising of finance, then only the interest element you can take. Interest element only you can take under the financing, not expense, not income, not remeasurement, not any other element. Okay. Once you have understood this, you have understood financing category entirely. Because remember, in your exam, this is one area which can be tested compared to the other areas. Okay, that is your financing, operating, investing, financing. And mostly in financing category, students often struggle because this is an area which is tricky. It's a little bit difficult also to remember, but with practice, you will remember. Okay, and if you can recall this table, this will help you a lot. Okay, just go through this table and stick to this. Now, let's go to the income tax category. Very small. All the income tax, whether current, whether deferred, are recognized in the profit and loss, should be presented in the income tax category. And the last one, discontinued operation. All income expense from discontinued operation will be shown here. Okay, as required by IFRS 5. But the way we measure those income and expense under discontinued operation will be done under IFRS 5. That is non-current assets held for sale and discontinued operation. So what are the 5 categories? Once again, operating, investing, financing, income tax, discontinued. Now, exam advice. In your financial reporting exam, questions you may be required. Okay, so in your FR exam, you may be required to prepare a statement of profit and loss in which you have to categorize income and expenses correctly, or you may be asked to identify within which category a specific item of income or expenses presented. One of these two. Now, coming to the totals and the subtotals in your profit and loss. Very important. Totals and subtotals in profit and loss, very, very important. Okay, so IFRS 18 requires 3 totals and subtotals. They are operating profit. Remember this. Profit or loss before financing and income tax. Profit or loss. Very important. What are they asking you? If it's operating profit, so this is the subtotal of all your income and expense that is in the operating category. This is all your subtotal of profit and income and expense in your operating and investing together. And this one is profit and loss for the period. It includes your income and expenses in all your 5 categories. So although profit before income tax is not a required subtotal, it should be noted that it is likely to be used where relevant both in practice and in your FR exam. Now, minimum disclosure. So the minimum disclosure, the line items that has to be presented in the profit and loss. See how we have done the line items for statement of financial position? Intangible asset, financial asset, investment, property, plant, and equipment, current asset, liabilities. Same for profit and loss. These are the line items. Revenue. We start with revenue. Operating expenses. Operating expenses, by the way, we are going to cover in the next section as well in detail. That is 5.5. Because the way we classify operating expenses also, there are different ways. Then share of profit and losses of associates and joint ventures using account equity method. Income tax expense. A single amount that goes to the discontinued operation under IFRS 5. So and in addition, the following items are required by IFRS 9 within your FR syllabus should be disclosed. That is your interest revenue. Remember, they have to be disclosed, not shown in the profit and loss, but disclosed. But this five items have to be shown, presented, has to be there in your profit and loss. But this items you have to just disclose. That is regarding IFRS 9, interest revenue. Then impairment loss. This is only regarding IFRS 9, okay? Interest revenue for IFRS 9, impairment losses for IFRS 9, gain and losses from derecognition of financial asset at amortized cost. Now, operating expenses. See, if you can't remember all this, or if you're feeling at this stage these things are a little bit difficult for you to understand, gain and loss from derecognition of financial asset at amortized cost, effective interest method, impairment loss, do not worry, you can just skip it and go. But once you finish IFRS 9, come back here, you will understand these things better. Okay. Now, operating expenses. This is also an area which can be tested in your exam. This is for financial reporting students I'm talking, not for SBR. For SBR, they will not ask because it's a knowledge level question. So in your operating category, an entity can present their expenses in one of the two ways. Okay. So they can classify according to nature or function. Each line item in your profit and loss, they can classify the expenses, only expenses I'm talking about, by nature or by function. But remember, all line items do not have to use the same type of classification. Some might use nature, some might use function. Now, classification by nature we'll see, and classification by function we'll see. So, in classification by nature, we aggregate the expenses according to the nature of economic resources used. For example, depreciation, amortization, raw materials consumed, employee benefit expense. Under function, we aggregate expenses based on the activity to which they relate. For example, cost of sales, selling expense, general and admin expense. Advantages for nature, if you classify by nature, it is used in many small entities and there is no arbitrary allocation of cost across functions. It's more objective and less judgment is required. On the other hand, advantages of classification by function are it provides more relevant information to users. Disadvantages is cost allocation is more subjective, so you need judgment here. Now, this exhibit 2 shows you the alternative classification. On one hand side, the left hand side, you can see expenses classified by nature, that is this, and on the right hand side, you can see expenses classified by function. So it both starts with revenue. Here also is revenue, here is revenue. The changes occurs here. Here, it's by nature. So they will go by raw material, employee benefit, depreciation, and get other operating expenses and operating profit. On the other hand, by function, we take cost of sales, then we get the gross profit, we deduct from operating income, we deduct sale, research, general admin, goodwill impairment, and here also we have other operating expenses, here also we have, and here we have the operating profit, and here also we have operating profit. The only difference is the way here you see how we have classified expenses here versus how we have classified the expenses here. That's the only difference. And mostly you will see in your exam also we go by function. Okay, we go by this format. Now, operating expenses. So entities has to classify expenses by function. If they classify by function, they have to disclose additional information on the nature of expenses, That is depreciation, amortization, staff cost. These they have to disclose. Why? Because when you classify expenses based on function, these things are not there. You can't look at the admin or selling expense and find out how much is your depreciation, how much is your staff cost. These are only there if you would have classified by what? Not by function. Okay, if you would have classified by nature. So that's why you have to disclose. Now, in your FR exam, you may be asked to classify operating expenses either by nature or by function. It could be one of the two. You have to be prepared for both. And it will be made very clear in your question. Okay. You may also be asked to disaggregate and present separately the material non-recurring items such as impairment loss. This is illustrated in Exhibit 2 again. If this is required, it will be made clear in the question. Now, format of your statement of profit and loss. So IFRS 18 will describe from section 5.2 to 5.5. They have described what it meant by the format of statement of profit and loss, where operating expenses are presented by function, which is as follows. So notice that there is no requirement to identify the 5 income and expense categories that are your operating, investing, financing, income, and discontinued. You don't have to categorize there. You will not be told to identify them. Okay. Now, this is the example. This is the example by function. You see, this is an example. So here you see it's ABC's statement of profit and loss. You have the two comparative years needed. And we start with the revenue and we deduct the cost of sales, get the gross profit. Then from other operating income, we deduct sale, R&D, impairment, goodwill, and we get the operating profit. Then we add share of profit of associate interest income. Remember this, till operating profit, it is the operating category. Then we moved on to the profit and interest income. Here we are in the investing category. Okay. So profit before financing and income tax. Then we take all the financing. All this are financing part. Interest expense on borrowing, interest expense on provision, profit before income tax expense, profit from continuing operation. Till here you are in this thing. And then once you reach to income tax expense, this is your income tax category. And then loss from discontinued operation. This is your discontinued operation category. And finally the profit. You see, these three are bold because only these three subtotals you need. One, operating profit, all the income expense from operating activity. Next, profit before financing and income tax. This is your investment category. And then profit, it takes all operating, investing, and financing. And also income tax and discontinued. Now, presentation. If an entity has an other comprehensive income, it is presented within its statement of performance. As explained in section 5.1, other comprehensive may be presented by extending the statement of profit and loss or by preparing a second statement. Regardless of whether you prepare one or two statements, statements presenting comprehensive income has to include totals for profit or loss. Okay, it will include subtotals for profit or loss and other comprehensive income. Now, and then once you add your profit and loss and other comprehensive, you get your TCI, total comprehensive income. Now, OCI. Items of income and expense are only presented in OCI rather than profit and loss if specifically required by an IFRS standard. A particular IFRS standard will tell you which item will go in profit and loss, which item will go in OCI. Okay, for example, IAS 16 tells you the remeasurement. Once an asset is revalued, remeasurement component goes to OCI. It is a rule of IAS 16, but not so in IAS 40 for investment property. So it differs. Now, OCI includes. See, in case you might be worrying, how will I remember so much, ma'am? Do not worry. Most of the things, major things goes to profit and loss. There are only few items which goes to OCI. So that makes you to remember OCI. Try to remember what goes in OCI rather than what goes in P&L because OCI list is small and anything not going to OCI, major portion goes to profit and loss. Okay, so that's how you study. Now, OCI includes any revaluation of your property, plant and equipment, especially if it's a revaluation increase. Remember, revaluation can go downwards also. Downwards revaluation goes to profit and loss. Okay, and they are reversal. Reversal means if revaluation goes downwards only up to the extent What is there in that revaluation surplus? You deduct from the OCI. Balance from P&L. If you're not able to understand now, do not worry. When we go to P&L, that is IS 16 in lecture 7, you will understand this concept very well. When I do it with numbers. Now, next in your IFRS 9, that is when there is a change in the fair value of your equity instrument that is measured at fair value through OCI. That is also in OCI, as the word says OCI. Then certain exchange differences, which we'll cover in lecture 19, that is IS 21, your foreign exchange goes in OCI, and the deferred tax effect, which we'll cover in lecture 17 again, IS 12. Now, presentation of OCI. How do you present OCI? Each of the different items of OCI is presented as a separate line item. Separately, you will write each one of them line by line. What about the group share? If you're in a company, okay, you are having a subsidiary, parent is having a subsidiary. So the group share of the OCI of an associate is presented separately. This will cover in lecture 25 under associate. Okay. Then OCI items will be grouped between those which are not reclassified to profit and loss subsequently and those which will be reclassified to profit and loss when specific conditions are met. What does it mean? See, certain items from OCI it will be shifted to profit and loss later. Certain items will always stay in OCI. It will never go to profit and loss. That is the meaning of will not be reclassified to profit and loss and will be reclassified. This list is very important for you. If it's not important in it might not be asked in financial reporting, but definitely in SBR it's very important. Items which will be reclassified versus items that will not be reclassified to profit and loss. This is only for OCI, not P&L. Okay. Now, items of OCI that will be asked in your financial reporting are items that will not be reclassified to profit and loss. So you only have to learn one category, but in your SBR you have to know both. Okay. Now, items of OCI can be presented net of related tax effect. That means you deduct the tax and show, or before you deduct the tax. In this case, tax efforts must be allocated and shown separately. The following exhibits show the two presentations. There are both the presentations will be shown through an exhibit. But remember, they include items of OCI that will not be asked in your financial reporting. It is only for illustrative purpose. Okay. In your SBR, yes, you need, but we are not going in depth here because since it will not be asked in financial reporting. That is first one, net of tax. This is how it will be there. So let us go one by one. You see, here also we have comparative, then we have year end, and it all starts with the profit, which you have calculated from your profit and loss. We extend that. Then income, that this is the heading you have to write like this. Income and expenses that will not be reclassified to profit and loss. And here you see income and expenses that will be reclassified to profit and loss. So first we'll finish the item not reclassified because this is asked in FR. Okay. So first, gain on property revaluation, not reclassified. Remeasurement of equity instruments measured at OCI, not remeasured. Classified. Remeasurement of defined benefit pension plan. This defined pension plan, that is your IS 19, employee benefit, not asked in your financial reporting. That standard will not be adjusted in financial reporting, but in SBR, yes. So I'm not going to teach you that here. See, wherever you see an asterisk, go down here. These items will not be asked in your financial reporting. Okay. Share of other comprehensive income of associate will not be reclassified. It will never go to P&L. It will always stay in OCI. Okay. See, here you see some deductions, right? That deductions is when your remeasurement or revaluation goes downwards, when it's a loss. Okay. Then you get your total income and expenses. Then these items will be reclassified. Later it can go to P&L. From OCI it will be shifted to P&L. They are your fair value of investments in debt instruments measured at OCI. But again, this will not be asked in your FR. It's there in SBR. Exchange differences on translating foreign operations. Again, not asked in FR, but SBR is there. Then loss or gain on cash flow hedges. Not asked in FR, but in SBR is there. So, then you get your other comprehensive income, net of tax, total comprehensive income. You see total comprehensive income. Now, let us go to the second format. This is before tax effect. So, before tax effect is the same things only. items that will not be reclassified, items that will be reclassified. So again, these are the same items they have asked. The only thing is this is before tax. Okay, it's the same thing, other comprehensive income, and then you get your total comprehensive income. So I'm not going to repeat the same point again. Let us go to the next. Allocation of profit and total comprehensive income. This is for consolidated statement of financial position. When you're preparing for a group, not single, that you have to allocate your profit and total comprehensive income among the parent and the NCI. So where a consolidated statement of financial position is prepared, profit or loss and total, not other, total. That means with profit you take OCI, total comprehensive income you have to allocate between NCI and the owners of the parent. This will be given to you based on the percentage. Let's say you have acquired 70%. So 70 is for the parent and 30% is your NCI. So you take 30% of your profit and 30% of a total comprehensive income and allocate to NCI, 70% to parents. This will be explained in detail in lecture 24 when we do group accounts. Next is the statement of changes in equity. So in this we are going to first go through the information that is presented in the statement. An entity should present a separate statement showing the following. First, total comprehensive income for the period, showing separately the total amounts that goes to parent and NCI. Next, for each component of equity, the effect of retrospective application or retrospective restatement as required by IS 8. IS 8 is your next topic that I'm going to cover in lecture 4. What is the meaning of retrospective? We'll see a little bit later. Now, for each component of equity, there should be a reconciliation between carrying amount at the start and end of the period separately, presenting changes from profit or loss, other comprehensive income, and transactions with owners in their capacity as owner, showing separately their contributions and distributions. Now, components of equity includes each class of contributed equity and the accumulated balance of each class of OCI and retained earnings. Changes in equity reflects the increase or decrease in your net assets. Except for changes that results from the transactions with owners, the overall change that represents the total amount of income and expense, including gain, losses, other comprehensive income generated by entities' activities. Now, in addition, an entity should present either in the statement of changes in equity or the notes. What is it? The dividends. Either they can show in their statement of changes in equity or they can show it as an under the note. The dividend that is recognized as distribution to owners during the period and the related amount per share. Now, the structure. The requirements of the statement of change in equity are most easily satisfied in a columnar format. So make sure that you do a columnar format with a separate column for each component of equity. And also you need a full year's comparative information must also be shown. Same like income statement and balance sheet. So you see here, this is the format for statement of changes in equity. Here we have share capital, we have share premium, revaluation surplus, retained earnings, NCI, and total equity. Total equity is the addition of all this type. And you see a note attributable to the owners of the parent. Let's see. So the column showing the subtotal of amounts attributed to equity holders of the parent should also be included. Okay. So we see here's the balance at 1st Jan and then 31st December. So we start with the changes in accounting policy. Of course, the opening balances will be given to you in the question if you are ever told to present statement of changes in equity. And then any changes in accounting policy can have an effect in your retained earnings, NCI, and hence total equity. And you write your adjusted balance. Then comes the changes in equity for the period. So we start with the issue of share capital. Share capital can affect your share capital and share premium and hence total equity. Then comes dividend. Dividend we deduct from retained earnings and NCI and the total equity. And the transfer to profit and loss and comprehensive income. So profit and loss will affect your NCI and retained earnings, and other comprehensive will have revaluation surplus that is affected and NCI. Retained earnings is mostly to do with profit and loss, not other comprehensive income. whereas revaluation surplus has to do with other comprehensive income. And NCR will affect both profit and loss and other comprehensive income, and hence total equity. And then you get your total comprehensive income, and finally the balance. Now, transfers within equity. Some IFRS accounting standards allow some transfers between the components of equity. For example, from P&L to retained earnings, from a reserve, a general reserve or revaluation reserve, you can transfer to retained earnings. That is known as transfers within equity. Both are part of equity. Your revaluation surplus and also your retained earnings. Like one example is IS 16. IS 16 allows the transfers of your revaluation surplus to retained earnings when you're disposing. Okay, either through depreciation or on disposal. This will be explained in more detail in lecture 7. Next, issue of compound instrument. This will cover in IS 32. An instrument which has both the component of convertible debt also and equity also. For example, convertible debt which you can convert to equity. So you have to separate the instrument into debt and equity on the initial issue. Although not required by IS 32, the initial amount recognized in equity is a separate component that could be transferred to another component of equity, for example, retained earnings, which will be explained in lecture 18. Now, the guidance. So, finally, we have moved on to the notes to the financial statements. So, we have covered almost all the other standards. The 4 financial statements we have covered: statement of changes in equity, statement of financial position, statement of performance. Now, the last part is remaining for this lecture, that is notes to the financial statements. And with this, we will conclude our IFRS 18. That is IFRS 18 guidance. IFRS 18 says the structure of the notes to the financial statements and the requirements for the disclosure of management defined performance measures and capital as well as other information. Okay, so IFRS 18 is giving guidance not only on notes but the requirement of disclosures on management defined performance measures as well as capital is given. So management defined performance measures will not be asked in your financial reporting, therefore not covered in this lecture, but it is there in your SBR. So in my SBR lectures, you can see that part included. Now the structure. Under structure, first the general content. The notes to the financial statement should include A. Information about the basis of preparation of financial statements and specific accounting policies used. How did you prepare the financial statements and which accounting policies did you use? That you have to write as the note. Next, which IFRS accounting standard? Okay, information required by the IFRS accounting standard that is not presented in the primary financial statements, you will write as a note. Then other information that is necessary to understand the primary financial statements. It's like a complementary to your financial statements. Next, order. IFRS 18 is requiring that your notes has to be presented in a systematic manner, but does not give a specific order. Okay, but it states that both understandability and comparability you have to consider when you are deciding on a systematic manner. You should be able to understand, user should be able to compare also. A suitable order could be based on the issues that are most relevant to the entity or grouped by a measurement feature. For example, anything that is measured by fair value, let us put them together like that. Next, remember, whatever order is chosen, each item in your financial statement should be cross-referenced to the notes. Now, usual order of presentation which has emerged in practice is like this. First, statement of compliance with IFRS. Okay, you have to make a statement that you are complying with IFRS. Next, your measurement basis, statement of measurement basis and accounting policies that has been applied. We'll see this in detail in lecture 4, the next lecture. Then, any supporting information for items that are presented in your financial statements in the order of the line item. And each financial statement is presented. See, the order of the line item that is there in your financial statement. Based on that order itself, you can give the notes. For example, in your statement of financial position, the first item often appears for any financial statements. Statement of financial position you will see is your non-current asset. Under that, it is your property, plant and equipment. So you can make a note number 1, property, plant and equipment. The basis that is used, the depreciation, the depreciation policy, things like that. Next item, let's say intangible asset. Then we'll write a note to intangible asset like that. Other disclosures, including your contingencies, commitments, and other financial disclosures, or it could be non-financial disclosure. Now, capital. An entity should disclose in the notes information that allow users of the financial statements to evaluate the entity's objective, their policies, and their process for managing capital. Okay, your note should be such that by reading the note, a user should be able to understand what is the objective of the entity, what are their policies, and what are the process for managing capital. Because see, just looking at financial statements figures, looking at profit and loss, looking at the cash balance, you will not be able to understand what is the entity's objective, how do they manage their capital. You should write it as a note. Finally, the disclosure. An entity should also disclose information about each class of share capital. A company might have more than one class. They have premium shares, they have ordinary shares, they have other shares. Also, including the number of shares that are authorized, issued, and fully paid, as well as reconciliation between the number of shares at the start and at the end of the period. Number 2, the amount of dividend that is proposed or declared after the financial statements were authorized for issue but not recognized in the period shall also be disclosed. So that's it for IFRS 18. We have finished entirely section A. As I told you, financial reporting is divided into 4 sections, section A, B, C, D. A we have finished, that is regulatory environment. Section A, we have touched section A in lecture 1 and 2, that is your IFRS and conceptual framework. Now lecture 3 onwards, we will be focusing on section B, syllabus section B of a financial reporting, that is each individual element in a financial statement. So from section B, we have started part 9, reporting financial and non-financial performance. So we have told circumstances where separate disclosure of material item of income and expenses required. Then from section D also, in preparing financial statement. This lecture will help you to prepare your single entity financial statement, okay, where you can be told to prepare statement of financial position, statement of profit and loss, and other comprehensive income according to the structure and the content that has been prescribed within the IFRS standard, and also the accounting treatment that is identified within the syllabus section areas A, B, and C. And prepare and explain the content and the purpose of statement of changes in equity. Now, let us summarize the lecture. So, IFRS 18 sets out the requirement for the presentation and the disclosure of information in your general purpose financial statement. There are 4 set of financial statements, and also notes for the reporting period as well as comparative information. A complete set of financial statement has to be reported at least annually. It can be longer also if entity changes their reporting date. Consistency has to be there when you are disclosing, okay, unless a change is justified. Items should be aggregated or disaggregated based on the characteristics that they are sharing or not sharing, okay. If they are sharing the characteristics, aggregate, not sharing, disaggregate. And also aggregation and disaggregation should be done to not hide important information, okay. Material information should not be obscure. Next, asset, liability, income, expense should not be offset. Asset and liability should not be offset, and income and expenses should not be offset unless required or permitted by the IFRS. Asset and liabilities in the statement of financial position should be classified as current or non-current. Minimum items that are specified for the financial statements, okay, and also additional line item may be needed to give a useful structure. Statement of performance can be prepared 1 or 2 statements. Statement of profit and loss, okay, has all the income and expenses classified in 5 categories: investing, financing, operating, income tax, discontinued. And operating category is the default category for items that are not identified in other categories. Now, the totals and the subtotals has to be presented for operating profit, profit or loss before finance and income, and profit or loss for the year. 3. There are 3 totals. Operating expense can be classified by nature or by function. All items of income and expense that are recognized in a period must be included in profit and loss unless an IFRS says that it has to be recognized in OCI. OCI, that is other comprehensive income, includes your evaluation increases and also reversal of those increase, changes in the fair value of equity instruments at fair value at OCI, or certain exchange differences and tax effect of these items. Remember this group of OCI. A separate statement of changes in equity must include the effects of a retrospective application and dividends recognized as distributions. Now, there are no technical articles for this lecture, that is IFRS 18, on your ACCA website. Thank you for watching, and I shall see you in my next lecture, that is IS 8. Do not forget to subscribe to my channel if you haven't subscribed, and you can purchase these slides from me. You can email me at accsavvy@gmail.com to get the details for the payment. And you can watch all the previous lectures until now in my FR lecture playlist.